You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubergen. Glad you decided to listen in today. Joining me in segments 2 and 3 of today's program is returning guest, Mr. Mark Jeftovic. Mark is the publisher of the Bitcoin Capitalist. He is also the proprietor of bombthrower.com as well as dollarcollapse.com. I always enjoy getting Mark's perspective on the world economy and the current state of currencies around the globe. So I know you're going to appreciate my interview with Mark. Again, that's coming up in segments 2 and 3 of today's program. I do have a special report available. This is just the second week we're offering it. The report is titled Tax-Free Retirement Income Strategies. I'll be glad to send you a free copy of that report with no future obligation whatsoever. Visit requestyourreport.com. Let me know where to mail the report, and I'll be glad to get you a copy of that report, as well as some bonus information. So again, the report, Tax-Free Retirement Income Strategies, available by visiting the site, requestyourreport.com. You know, when it comes to the economy, there is one word, in my view, that sums up the biggest threat to the economy, and that word is simply debt. I've talked about this previously here on RLA Radio, but I believe both private sector debt and government debt will play a role in what could be an emerging perfect financial storm. Now, as I'll talk about with Mark on today's program, this past week I read a statistic that was alarming. Interest on the national debt, interest on U.S. government debt now consumes 76% of personal tax receipts. Now, personal tax receipts are the largest source of revenue for the U.S. government. So 3 out of every $4 that you send to Washington goes to pay interest on the U.S. government debt. That statistic alone demonstrates to you how simply out of control U.S. government debt actually is. The national debt of the United States now stands at about $35 trillion. Now, that's a number that's nearly impossible to get your arms around. I mean, just a trillion is a number that's very difficult to get your arms around. But let me just attempt to put that number in perspective. According to the national debt clock, to fully retire the debt, every American citizen would have to write a check for $103,565. If you're empty nesters and you're married, both you and your spouse will have to write a check for $103,565 to pay off the national debt. Now, that number is a bit misleading. Here's why. Not all Americans, not even a majority of Americans, are in a position to write a check for that amount. So for discussion's sake, for this conversation we're having today on the program, let's narrow the math to include only American taxpayers in the calculation. So in other words, we'll exclude Americans who do not pay income taxes. The national debt spread only over U.S. taxpayers would have each taxpayer writing a check for $266,953 to wipe out the debt. Those numbers tell you that national debt, the national debt, is already at an unmanageable level. Now, here's the harsh reality. It can never be paid. Now, please don't shoot the messenger here. I reached this conclusion by doing fourth grade math. At least it was fourth grade math when I was in school. Think about these statistics. The $35 trillion national debt of the United States is more than the total economies of China, Japan, Germany, and the United Kingdom combined. The debt level of the United States now exceeds the economic output of China, Japan, Germany, and the UK combined. Now let's just focus on $1 trillion. If you spent $1 million every day since the birth of Christ, you would not yet have spent $1 trillion. If you line up $1 bills end to end, you could go to the moon and back about 203 times with $1 trillion. You could wrap these dollar bills, these $1 bills, end to end around the earth 3,893 times. Speaking of time, to use a time reference, 1 trillion seconds is about 32,000 years. Now, when you take those examples that are mind-boggling, multiply by 35, and now you begin to understand the magnitude of the national debt problem. But unfortunately, the fiscal problems of the United States don't stop there. In fact, that $35 trillion debt in reality is just the tip of the proverbial iceberg. Social Security and Medicare also woefully underfunded. I talked about this on the program within the last month, but according to a recent report by the U.S. Treasury, Social Security and Medicare are underfunded by more than $173 trillion. Now, let me put that number in perspective, or attempt to. $173 trillion is far larger than the gross domestic product of the entire planet. If you take the total economic output of the entire planet, you get about 104 trillion. So the underfunding of Social Security and Medicare exceeds world GDP by $69 trillion, which is about twice the level of the current U.S. government debt. Now, if you take that $173 trillion number and you adjust it for the official inflation rate, so we could go into a discussion about, is the inflation rate accurate? We've talked about that on the program in the past. It is obviously not. But if you adjust it for the official inflation rate, the $173 trillion number is nearly as much as our government has spent on everything since the Constitution was written back in 1787. So let's take the official national debt of $35 trillion. Let's add it to the unfunded liabilities of Social Security and Medicare, and we get a number of just under $210 trillion. But again, the story doesn't stop there. That $210 trillion number does not include the unfunded liabilities of other government programs, one being Medicaid. I have seen estimates of the U.S. total fiscal gap being more than $250 trillion. Let's, for today's discussion, just say it's north of 200 trillion. Now, according to the Federal Reserve, the central bank itself, U.S. households and U.S. nonprofit organizations have a net worth of 161 trillion. The Federal Reserve tells us that corporations, excluding financial corporations, have a net worth of about 60 trillion. So that's a total net worth of about 221 trillion. What does that mean? I just walked you through the math. That means 100% of the wealth of households, nonprofits, and non-financial corporations could be confiscated with a 100% wealth tax, and we still come up short. Now, those of you who are paying attention know that I excluded financial corporations from that equation. I don't think that it is unreasonable to state that financial corporations may not be in a position to kick in anything. Total worldwide derivative exposure, which are really side bets between banks to keep it very simple, according to Egon von Greyerz, they're at $1.5 quadrillion. If you can't get your arms around rather 200 trillion, try 1.5 quadrillion. That is truly an unfathomable number. So the bottom line is this: the U.S. government has too much debt and too many unfunded liabilities to ever possibly pay. And it may be that that proverbial rooster is now coming home to roost, with 76% of personal tax receipts now going to pay interest on the debt. My point is this: the environment that we are approaching, in my view, will be a much different environment for retirement income planning than at any time in the past. I would encourage you to that end to get this month's special report, Tax-Free Retirement Income Strategies. And when you request that report, I'll also send you a copy of the revenue sourcing book that contains a retirement planning strategy for the current economy. So if you go to requestyourreport.com, I'll send you a copy of the Tax-Free Retirement Income Strategies report. I'll also send you a copy of the revenue sourcing book. I will be back after these words with my special guest, Mr. Mark Jeftovic. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me once again on today's program is returning guest, Mr. Mark Jeftovic. Mark is a prolific writer, commentator, all-around bright guy. You can check out his work at bombthrower.com. He is also the proprietor at the website dollarcollapse.com. I'd encourage you to check both those out. In fact, I will tell you dollarcollapse.com is where I go for a lot of my news links. So, Mark, appreciate your work and welcome back to the program.
Hey, Dennis, it's always great to be back.
So, Mark, let's just jump in here. You are in Canada, so let me phrase the question a bit differently. Can you rank the health, in your view, of the North American economy, focusing primarily on U.S. and Canada?
Yeah, I think we are in a recessionary economy. I think that the pain is being felt across the board on nearly all businesses. My day job is I run a tech company, and we've seen the tech sector doing layoffs for about a year, like since the year started, like crazy. And there's this sort of strange bifurcation from the stock markets, which are kind of like racking up all-time highs, and the real economy is just taking a hit and taking a hit. And I think ordinary people are being squeezed by inflation still, regardless of how the politicians describe a lower rate of inflation as somehow prices are going down. They're not. They're just not going up as fast as they were maybe a year ago, but they're still going up. So everyone's money is still losing purchasing power, and businesses are still feeling, I think, compression and margin compression. And then against that, you have these like stock markets are taking off. It's almost like a classic crack up boom.
Yeah, and it's many, many times over the past several months I've gone back to that quote from Ludwig von Mises, so I certainly agree. When you look at inflation, you make the point, Mark, that inflation hasn't stopped. It's maybe just not rising as quickly as it was, and yet we have politicians and seemingly the Federal Reserve here in the U.S. taking a victory lap, stating that we're probably going to look at some rate cuts moving ahead. Doesn't that just feed more inflation? And isn't that really the Fed saying one thing and then throwing in the towel on inflation and saying, we're going to have to either pick the economy or inflation? We can't win both these battles.
Yeah, that's exactly what's going on. And here in Canada, the politicians are doing exactly the same thing. When they're not demonizing business owners for creating inflation, they're taking victory laps for inflation, pulling back to like 2.3% instead of like instead of where it was for, even though that's still well above their target. Setting aside for the fact that I think targeted inflation is insane, but there you have it. It's the stated policy of every, G20 nation on earth. And people like you and I have been saying this for years. We've been saying the central banks are trapped. They can't raise rates to where they would naturally be in a free market because there's too much debt in the world. There's just too much debt. And we were talking about that before we started rolling the tape, how in the States, you were saying, 3/4 of the personal tax revenues are going to pay, was it interest on the debt, not even the principal?
Interest on the debt only.
Right. So, there's too much debt. They can't raise rates. Inflation is starting to really hit Joe Public where it hurts. During COVID and after the GFC, we had all the inflation was in assets. It was like an asset bubble inflation, and we could get away with holding interest rates at zero for all that time. Then after COVID, it started to show up on Main Street, and the politicians had to do something. And I think all they really did globally was reset rates as high as they could without destroying the global financial system, without setting off a massive debt crisis, so they could lower them again. That was really all they were doing, was reloading the chamber. And they did almost cause a debt crisis. We had the regional banking crisis last year. You saw how fast the taper got thrown overboard when that hit. And so this is just the Fed being trapped. And now that they've kind of gotten to this point where, you're right, to your point, they are choosing to, they're choosing to avert a debt crisis, and they're throwing, the middle class and small businesses overboard, because it's going to cause inflation. We're in a high inflation environment for as far as I can see. Once the debt cycle, once the rate cut cycle really kicks in. In Canada, we just had our second rate cut yesterday or Wednesday. The rate hike cycle is over here in Canada. It's over in England. It's over in Switzerland, and it's about to end in the States.
Yeah, and for our listeners' reference, Mark and I are recording this conversation on Friday, July 26th. So Mark, let me go back if I could. You just said there's simply too much debt. I'm looking at the U.S. numbers. I just researched this for a radio program. Right now, private sector debt, when measured as a percentage of the economy, is at least 50% higher than it was in 1929 at the onset of the Great Depression. At that time, government debt was about 17% of economic output. We're now at 130%. As we just discussed, 76% of personal tax receipts in the U.S. are to pay interest on the debt. How can the Fed cut interest rates and sell U.S. government debt honestly? Doesn't this turn the Fed back into a buyer of last resort, and inflation goes up exponentially from here? At least that's how I kind of see things playing out.
Yeah, I agree, because the whole "this time is different" cliche, but in this context, we've never before been sort of primed for a whatever kind of crisis you want to call it, fiscal, debt, currency, whatever. With this, we have no margin for error. We have no wiggle room. When you cited those numbers in 1929, or in 2000 when the dot-com crash happened, or in the GFC when that happened, like, all of these levels were not where they are today, especially after COVID. So they have no margin for error. They can't raise rates, as we just talked about. And so we're starting from this maxed out point where everything was just sort of held together with spit and twist ties. And now they're going to try to start not tapering. They're going to start cutting into this thing that's just going to cut loose this inflationary spiral. And they can't raise rates. They cannot do that. And the thing, I almost lost my thread of thinking on this. What's different also today is we have this emerging de-dollarization theme globally, which was not present before. There was always the US dollar as the world reserve currency, and there will always be a market for US sovereign debt. And that has changed. That is different than it was even 2 years ago. So you can't lower rates, reduce the incentive for foreign sovereigns, foreign countries, foreign corporations to even hold U.S. Treasury debt as an asset. So the Fed is going to have to monetize that. That's what's going to have to happen. And they're going to probably have to come up with some way to do it in a way that just doesn't look like flat out QE or something, but they'll do something. They're going to have to monetize this debt.
Well, my guest today is Mr. Mark Jeftovic. Check out his websites at bombthrower.com and also dollarcollapse.com. Mark, you made the comment that this appetite for U.S. government debt, this appetite for U.S. dollars has changed a lot, even in the last couple of years. Could you expand on that a little bit for the listeners?
Yeah, sure. I mean, it's might even be a good segue into the second component because what happened almost very close to each other a couple of years ago, two events happened that, in my mind, started the de-dollarization theme in earnest at a national, like nation state level. And something else happened here in Canada at a personal level that made individual citizens have to do the same calculus in their head. And the things I'm talking about are number one, the US government confiscated the foreign reserve assets of two sovereign nations. Now, I mean, Afghanistan is not a libertarian paradise by any stretch, and Russia invaded another country. So it doesn't really, we can set aside what these nations did to get their assets confiscated, but it still happened, and it changed the calculus for every other nation state in the world because it meant if we do something the U.S. doesn't like, they can seize our assets. They can take what we think are foreign reserve, strategic reserves, and they can just take them away from us. And that's a problem. And then on the individual citizen level here in Canada, during the Freedom Convoy, the Trudeau government declared martial law and started seizing bank accounts of people who supported the truckers. And that made every individual worldwide think that, oh, you mean if I do something the government doesn't like, they can just take my bank account away. The whole de-dollarization theme started happening around, like it started picking up steam around that time. You saw the BRICS start getting serious about starting their own currency block, and you started seeing China and other countries, Saudi Arabia, saying, maybe we'll settle trade balances in something other than US dollars. And on the individual level, you saw people embracing, wait for it, drum roll, Bitcoin and things that cannot be confiscated. And we even see that, at corporate levels, and we're seeing it, we're seeing nation states moving into Bitcoin mining. So those two events changed the calculus of how people and nations structure their reserve assets. And it changed the conversation entirely to what can we actually store our wealth in that will always be ours, no matter what happens someplace else in terms of our relationship with the government or some foreign government. I'll stop it with when RFK Jr. spoke at the Bitcoin conference in 2023, a year later, he said, what turned me into a Bitcoiner was watching what the Canadian government did to the truckers. So.
Well, my guest today is Mr. Mark Jeftovic. Check out his websites at bombthrower.com. Also, check out all the terrific news links and articles at dollarcollapse.com. I'll continue my conversation with Mr. Mark Jeftovic when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm Dennis Tubergen, your host. I'm chatting today with Mr. Mark Jeftovic. If you're just tuning in, I'd like you to check out Mark's websites at bombthrower.com and dollarcollapse.com. Dollar Collapse is one of my go-to news sources, and I would encourage you to check out all the links and all the articles there. Again, that's dollarcollapse.com. So, Mark, in the last segment, we talked about the fact that you mentioned that BRICS, the BRICS countries, originally Brazil, Russia, India, China, South Africa. Now there's, Iran's there, Saudi Arabia, United Arab Emirates, to name a few. It seems like the petrodollar now is dead or on life support. And as far as BRICS coming up with their own international currency to use in trade or trading currency, to phrase that another way, talk a little bit about petrodollar and the status of the BRICS currency as you understand it.
Yeah, for me, the main characteristic of it is how fast it was unfolding. Because a few years ago, I put out a little booklet. You can actually still get it on Amazon, or you can get it on bombthrower.com for free, actually. The Crypto Capitalist Manifesto. And it talked about things like de-dollarization, and it talked about the sunset of the US dollar as the world reserve currency. And I typically think of these things in almost generational increments, 5 years, 10 years, 20 years. the BRICS, the rise of the BRICS as a emerging currency bloc astonished me at how fast it was happening. I thought this was going to play out over 5 years, over 10 years, and suddenly 24 months later, it's a reality. It's not like done. They still don't know exactly what they're going to do, but they're already pricing things in non-US dollar terms. To be sure, the US dollar, it's not going to zero tomorrow. It's not going to lose world reserve currency status instantly. At least I still don't think so. These things have a long tail, but it is playing out a lot faster than I thought it was playing out. You know, that famous phrase by Hemingway, gradually then suddenly. It's like we're kind of at that inflection point between gradually and suddenly. And it feels like we're sliding down the suddenly slope of that, which still is going to take years to play out, but it all just happened sooner than I thought. And again, it was those catalyzing events that happened in early 2022 that I think lit a fuse under that.
So, Mark, you mentioned the last segment, and I made a note to ask you about it in this segment, that you now have a number of nation states that are engaging in Bitcoin mining. So, two-part question, please. First, for our listeners that maybe are not familiar with Bitcoin mining, just a quick explanation, and then get into the nation states that are now involved in the process.
Yeah, so Bitcoin mining is how the Bitcoin network maintains its integrity and security. It's a decentralized process where you plug in a specialized machine called an ASIC, because that's the chip that is used specifically for Bitcoin mining. It solves a math equation, a very difficult math equation. These machines do, like, I can't even visualize like a one and the number of zeros after it computations per second. They're measured in what are called exahashes per second. And the miner that solves that equation for the current block wins the right to append, like to sign the block and append it to the blockchain, which is why it's called a blockchain. And then all the other miners sort of confirm that block. Yes, this is the correct solution. This is the new block. And so the blockchain extends by another 10 minutes. And it is cryptographically secure, so nobody can double spend a Bitcoin or a portion of a Bitcoin. And for doing that, the miners win what's called a block reward. They get issued 3.125 new Bitcoin for doing it, and then they also sweep all the transaction fees for that block. They win those as well. And so globally, there is this network is the most decentralized, powerful computing network in history that is just humming away, crunching away this Bitcoin blockchain. Nothing comes even close to it, even rival cryptocurrencies. Many of them don't even use this kind of algorithm. And that's a whole different conversation that would take us an hour to sort through. And so what we see now, countries like Russia have entered into partnerships with private companies to do Bitcoin mining. Ethiopia has just signed a deal to do sovereign Bitcoin mining so that they're going to pay a company to mine Bitcoin and the proceeds will go to the sovereign, balance sheet of the country, or what maybe they'll sell it. I don't know. Most Bitcoin miners actually keep the Bitcoin that they harvest as much as possible. And even here in Canada, you have like these government incentive programs to attract Bitcoin miners to bountiful energy jurisdictions like certain places in Quebec and even out in Alberta. And so they get these tax credits to set up shop as Bitcoin miners. And so private companies take advantage of these government incentives. And there's this theory, or there's speculation is sort of a better word for it, amongst the Bitcoin crowd, that sometime in the next year or so, we're probably going to find out that some government somewhere has been secretly mining Bitcoin and keeping it off the radar as much as possible. We don't know who that would be. But it's sort of the next logical step. China is hoarding gold like crazy. Some country somewhere is probably mining Bitcoin. And then, of course, there's El Salvador that made Bitcoin legal tender. So they were the first country to do that. And they are mining, powering their Bitcoin miners with the volcano there, thermal, using geothermal and issuing bonds against it. So, it's starting to happen at a nation state level.
So, Mark, in the time we have left, talk to our listeners about, in your view, why they should own Bitcoin. Do they own Bitcoin instead of gold and silver, in addition to gold and silver? What's the philosophy that, in your view, investors, particularly maybe aspiring retirees, should follow?
Yeah, I am a Bitcoin and gold guy, a Bitcoin and precious metals guy. I have never been one or the other. I'm a gold bug from the mid 90s. So I still hold the yellow metal, still appreciate it. My mantra is optionality, right? We live in a really unpredictable world that's, in the process of going non-linear, right? We're coming out of this top-down, centralized industrial world view, and the world is shifting into this decentralized network sort of configuration, very nonlinear, very unpredictable. Phase shifts happen out of nowhere in a chaotic kind of dynamic. So you want different kinds of optionality. Gold and silver gives you a certain kind of optionality that has been unblemished for 5,000 years. Bitcoin is a new kind of optionality. And the main reason I like it, not about the price appreciation, although nothing has appreciated like Bitcoin in world history, but that's really just, I think, fiat currency losing purchasing power more than anything. But what I really like about Bitcoin is the capital mobility. You can memorize your seed phrase, which is 12 or 24 words, uh, and you can just get out of a certain jurisdiction with your skin intact, walk some, get someplace else, and using your 12 words, you can restore your wealth. And you remember the old American Express commercial, the guy out at sea floating in the dinghy, and they rescue him, and he just pulls, like, he's got an American Express card in his shirt pocket, and suddenly he's in a restaurant and they're bringing him food, and he's in a tailor, and he just looks like $1 million and gets on a private plane at the end of it. That's Bitcoin in this era, right? You just memorize your 12 words, or you have a secure wallet, and you can walk around with billions of dollars in your head because you have a brain wallet, and nothing else is like it. Even other cryptocurrencies, Bitcoin is a category of one. So I would recommend a minimal, excuse me, a minimal allocation. Like, you don't go all in. You don't go all in on anything. You have a minimal allocation in your portfolio, and preferably like some kind of method of accruing it over time, like a dollar cost average, regardless of the price, on a go forward basis. And my favorite way to do that is to earn it in my business. So I take Bitcoin as a payment method, and when people pay me in Bitcoin, it just goes in a special pile and it just stays there.
So, Mark, given that Bitcoin, in your view, is a category of one, how do you see other cryptocurrencies like Ethereum, Ripple? I mean, there's scads of them. You would know them far better than I. How do you see everything else falling out? Is Bitcoin the last and only crypto standing, or how do you see this playing out?
No, I see this is like a Cambrian explosion. And the way I explain it to people is like Bitcoin is a protocol level innovation. It's like TCP/IP or Unix, and everything else, Ethereum, Helium, Filecoin, those are all applications. Those are all startups. Those are like Excel and Microsoft Word and SlideShare. Some of those are going to do exceptionally well. Like, some of those are going to make millionaires, right? Or billionaires. but they're not a protocol level innovation. A lot of them are still centralized. A lot of them are controlled by a small group of insiders. A lot of them have almost a security like structure because they're funded by ICOs. So it's a whole new ballgame. It's a whole new class of asset, but they are all secondary to Bitcoin. And so, what we do in the newsletter, one, we follow publicly traded companies in the space, so you can get that extra torque and leverage by owning some of the equities, and that way you can actually even get some exposure to the space inside your retirement accounts as well. And then we cover the actual altcoins themselves. We call them blue chip cryptos because there are definite cycles in this space, and you want projects that have shown the ability to survive those cycles. I mean, the sort of inside baseball in this space is it's during the bear markets that the winners of the next market are building out, and the ones that survive those bear market segments usually come out roaring in the next cycle. And so we try to stay allocated. We have a small allocation. Like, again, we're not saying blow out your portfolio and just own this stuff. It's like 5 to 7% for the crypto and Bitcoin stocks in your equities portfolio. You can go a little higher now because I think we're at the beginning of a like crypto's sort of in another up cycle. So we can go 10 to 15% if you want to be a bit more aggressive. I'm way higher, but I'm kind of ideologically all in on this, but I'm still not at 100. And then on the altcoins, whatever, you take 2 or 3% of your net worth if you're going to put it. Well, the majority of that should be in just straight Bitcoin, and then 10% of that you can put into an altcoin portfolio because you can get 50, 100 Xers in some of those altcoins.
Well, my guest today has been Mr. Mark Jeftovic. And Mark, I mentioned bombthrower.com, dollarcollapse.com. If somebody wanted to learn more about your work, is that where you would direct them, or what instructions would you have for them?
Yeah, I'd go to bombthrower.com, get on the free mailing list there. You'll get a copy of the Crypto Capitalist Manifesto. And if you go to bombthrower.com/RLA, we'll put a deal on the Bitcoin Capitalist newsletter for your listeners.
All right. Well, thank you so much for that. And thank you for joining us today. Always a pleasure to catch up with you. And I'd love to have you back down the road for an update.
Always a pleasure to come back on.
We will be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Glad you're listening in today. And thanks again to my special guest on today's program, Mr. Mark Jeftovic, for joining us. In the first segment of today's program, I talked about the fact that when you take the official national debt, when you take the unfunded liabilities of Social Security and Medicare, using the numbers from the U.S. Treasury, you get a fiscal gap of about $210 trillion, which equals roughly the entire net worth of the United States. I also pointed out that according to a recent report, 76% of all personal tax revenues at the federal level now go to pay interest on the national debt. We are quickly approaching a point, as I talked about with Mark Jeftovic today, that we will have to see some type of a reset. The bottom line is this: if there is too much debt to be paid, it will not all be paid. Now, in my conversation with Mark, I mentioned the fact that U.S. private sector debt today is about 220% of gross domestic product. That means for every dollar the U.S. economy produces, there's private sector debt of about $2.20. Now, let me put that in context for you. The Great Depression of the 1930s was arguably caused by debt excesses. These debt excesses led to the worst economic environment, a deflationary environment, the worst one in the last 100 years. And entering the Great Depression, private sector debt was about 140% of the economy. That means there was $1.40 in private sector debt for every $1 of economic output. Now, let me stop there. Presently, there's $2.20 of private sector debt. This excludes government debt. We're talking only private sector debt. There is $2.20 in private sector debt for every dollar of economic output. In 1929, entering the Great Depression, that number was $1.40. So it's alarming when you think about it, when you consider the numbers, that private sector debt today is more than 50% higher when measured as a percentage of economic output than it was at the onset of the Great Depression. Now, that one fact alone should make you extremely concerned. But when you couple that fact with what we talked about in the first segment of today's program, it should simply put you on high alert. See, in 1929, Social Security didn't exist. Medicare didn't exist. There were no unfunded liabilities in those programs. Today, the unfunded liabilities of those programs, according to a U.S. Treasury report, is $173 trillion. In 1929, U.S. government debt was about 17% of economic output. Today, government debt is about 130% of economic output. So if we do the math and add private sector debt and public sector debt, and we add those numbers together, in 1929, prior to the onset of the worst deflationary period in the last 100 years, private sector debt and government debt totaled 157% of the economy. Government debt was about 17% of the economy. Private sector debt was 140%. That's a total of 157%. Presently, total public and private debt total 350% of the economy. Now, that doesn't even count unfunded liabilities. So even throwing the unfunded liabilities of these programs aside, we have more than twice the debt now that existed in 1929 when a painful deflationary period materialized. So can we really expect an economic happy ending? As I talked about with Mark Jeftovic on today's program, it's my belief the Fed is going to have to decide to try to stop inflation or to try to prop up the economy, and I believe they will choose the latter. That will likely mean more inflation near term, but at a certain point, make no mistake, we will have to have a deflationary period. History teaches us we will always have deflation when there's too much debt to be paid. So that said, I'd like to invite you, as I close today's program, to get some of the free resources that we have available for you. I have a brand new report titled Tax-Free Retirement Income Strategies. I'd be glad to send you. All you need to do is visit the website, requestyourreport.com, and I'll be glad to get a copy of that out to you in the mail. Again, no cost, no obligation. And when you request the report, I will also get you a copy of the best-selling book, Revenue Sourcing, that contains a retirement planning strategy for today's economy. So to get all that information, again, just visit requestyourreport.com, and I'll be glad to get that information out to you. Also, if you don't yet have a free login for Retirement Lifestyle Advocates, there are a lot of resources there that we update every week. The podcast version of this program is posted there, as well as my weekly newsletter, as well as my weekly headline roundup newscast. That is all at retirementlifestyleadvocates.com. That's all the time I have for this week. Glad you decided to listen in. I'll be back again next week.